In Investment Gurus, Aisha and me caught up with Parag Parikh's Rajeev Thakkar, who is known for his contrarian calls and is the man behind one of India's most admired value investing houses. He recommends investors must stay away from the noise and stay calm. He believes there are multiple levers for auto companies to improve efficiencies, and while banks could see margin pressure in the near term, it has potential for growth. Listen in to a slice of that conversation.
It may seem like we have done nothing, but that is not the case. So while people think that we have been largely in cash in the region of 20 to 25% and we have not been doing much, we have actually added stocks. We have sold some of them. On a net basis, the result may seem like we have done nothing, but there have been activities that we have been doing. So on both sides, we have been active, buying as well as selling.
But the fact that you've increased your cash levels, is it more of a valuation call, or is it more sort of sense of caution because of what's happening around the world?
It's nothing to do with the global events whatsoever. So just for context, when global environment was in the news, March of 2020, we ran down cash from 13% to 3%. So we deployed 10% in a single month. So it's nothing to do with global events, not to do with Russia-Ukraine war or tariff being on or off, or India-Pakistan tensions, or nothing around that. It's pure and simple valuations. There are pockets which are looking attractive where we have invested, but we cannot invest beyond a point in the same set of companies or in select sectors. So that is resulting in some cash in the portfolio.
Got it. So you've come in and you've bought some stake in companies in the auto sector, and I don't want to name those companies because maybe there is a conflict there. But talk to us about the thesis at play there, because auto has run up quite substantially, and this is of course on the back of consumer discretionary likely to do well. And we know you to take long-term calls, right? So talk to us about maybe the next 2 to 3 years that you're seeing. Is there an unwind expected in auto in a big fashion? And give us your thought process behind that call.
So auto is a space which I think is going through a lot of transition elements in a sense. And we had been very, very cautious in this space. We had one four-wheeler company. We had trimmed other exposures largely. So that was all there was there. The transitions that I am referring to, at one end, while unit sale numbers were somewhat subdued, but that transition from small hatchbacks and sedans to the large form factor SUVs was one big trend. And the bigger question was about the powertrains. After petrol and diesel, what? So at one end, there has been this whole ethanol blending thing, CNG as a powertrain, diesel, will it be there, not be there in the CAFE 2 norms and onwards? What will happen to electrification? So all these were questions, and we had caution on account of the entry of Chinese players into India. So you had BYD coming in, you had MG coming in through JVs. After a while, one thing is clear, we will not give a free rein to the foreign players.
Correct.
So that is very, very clear to me at least. The second thing was a lot of the domestic players actually upped the game in terms of the product launches, etc. That gave confidence, and the GST cuts were a lucky happening after we bought the stock, which is reviving the sales and things like that.
But sir, two key risks here, right? And they've always been prevalent, especially in sectors like auto. Your return ratios are quite compressed, traditionally always have been. It's sort of commoditized with the global marketplace and technology in the global marketplace. And that technology, at least in the global marketplace currently, in terms of the delta versus India, is probably the largest that we've ever seen it in the last 2-3 generations. So what? How should one hedge for some of those risks, and how do you view those? Try and give us that context versus what you've invested in. How do you view those risks versus the investment you've made?
So there are various levers for auto companies to improve efficiencies. So two-wheeler companies actually have been at the forefront of that, where they farm out a lot of the work to ancillaries. They focus more on the branding, product design, and after sales and things like that. So that, of course, is a lever which can be played even by four-wheeler companies. Return ratios haven't been that bad in the Indian context, at least in these spaces where we invest in. Technology, yes, it's a risk transition and things like that. But if you look at the new powertrain, EV, the biggest technology factor there is the battery pack and the motors, etc. Rest of the car, we know how to build good quality cars. So the suspension, the seating, the windshields, and rest of the body, we are more or less there. And some of the product launches have been quite good. So if you look at the vehicles on the road, they have been quite of acceptable quality.
Oh yeah, absolutely. Other than autos, where is it that there is bottom-up value?
So there are very few sectors in India which are now still under licensing, and where their entry barriers are reasonably high. Banking is one of the spaces. Near term, maybe there could be margin pressures because the interest rates on advances reset quicker than the interest rates on the deposit book. But that is one space which hasn't done that well. When people go out and buy more homes, when people go out and buy more cars, the financing will come from the formal sector. A lot of attention in the last few years has been on the NBFC space. But I think one should not ignore the banking space. I think that is one space which is looking reasonably attractive.
But again, when it comes to banks, there is such fierce competition. The market looks at private banks, PSBs, smaller PSBs, all in every bank with a very different lens. Where within the entire umbrella of banks do you find preference or do you prefer?
So when most individuals look for a bank, when they have to select a bank to open their account, they look for a few things. You need an adequate branch network, ATM network. You need a good tech stack in terms of the net banking, the app. You want the entire ecosystem. So you may want to open a securities brokerage account with them, or you may want a suite of products from them, let's say mutual funds, life insurance, general insurance.
All of it in
all
one.
of it in one. So there are largely 4 large private sector banks and 1 public sector bank which make the cut. Remaining are there in the tier 2, but they are still not right up there. So this is the space where we track for opportunities.
And give us this thought process behind the SIP flows being so large, depriving the banking system of deposits. Is that at all a risk? I know you have a very unique view on this one.
Sure. So 2 things here. One is bank lending cannot be happening, at least to the corporate sector, unless the companies are well capitalized. So one of the ratios that people look at is debt equity ratio. Without equity issuance, banks will not be able to lend to the corporate sector. The other thing is that money does not leave the banking system. Money can come in or go out of the banking system largely on account of central bank actions or whether government is spending money or not spending money. When a individual gives a SIP inflow to a mutual fund, that money goes from the individual's account to the mutual fund's bank account. When the mutual fund buys stock, the money goes out of the mutual fund's bank account to someone else's bank account. So actually this is a misnomer in my view. I don't think money leaves the banking system. There can be disintermediation of banks if people put money in bond funds and bond funds start buying corporate bonds. So to that extent, banks' business could go down. But that hasn't really taken off in India. Largely our market is restricted to AAA corporate bonds. And that it's been that way for many, many years now. So I don't...